This episode is intended exclusively to provide information and education to help individuals better understand cycles. However, this information is not be construed as professional advice as to the buying and selling of securities or other investment instruments. In no event does the host express any opinion with respect to or make recommendations regarding the purchase or sale of any particular investment instrument. There is a very high degree of risk involved in trading securities. Buying and selling decisions are solely within the personal discretion of each individual.
From the mind of Lars von Tienen, the most advanced cycle analysis, hot off the press.
Welcome to the Foundation for the Study of Cycles. I'm happy to see you here. We are all interested in the question, is the current US stock market overvalued? Where are we at the current point in time? And for that topic, there is an interesting indicator, but Warren Buffett proposed some kind of measurement to answer the question if the stock market is overvalued, yes or no. That's the so-called Buffett Indicator. And I will go to that type of indicator he was at least using to get a clue on this overvaluation, yes or no. And what I wanted to check with you today is, this indicator might give you a calculation in calculating a measurement. But as always, if you calculate measures based on price or valuation, it will give you a current situation or the values in the past, but it will give you no clue on timing. And that's the purpose why we are here at the Foundation. We want to check if there are cycles available which can give us, in addition to the absolute rating which Buffett introduced, is there some kind of cyclic rhythm in that indicator? And that's the purpose why I think, let's use our cycles knowledge, let's use our tools we have here at the Foundation, let's check the Buffett indicator as a time series, and let's see if we can find a cycle in that measurement. And if so, maybe, and that's the topic why you need to stay until the end, and I'm finished here for today, what does this mean on timing today or looking into the future? So that's what I try to answer in the next 15 minutes together with you. So feel free to drop in your questions. We are live today, so I'm happy to take your questions latest at the end. I will follow the live chat section while we are going. So please drop in your comments. So what is, maybe a short note on what is the Buffett indicator? And you can review that on the web by yourself, and I don't want to take too much time on that. But just in general, so the Buffett indicator, I think it was published in the year of 2001 was the first time he brought that measurement into public from his thinking. So it's really simple. It just takes the total value of the US stock market. So you can take an index, like the Wilshire 5000, which is a very broad one. You could use other US stock market indices to get a clue on the first information. We need the total value of the US stock market. And then he divided that information by the current GDP, so the gross domestic product. And by doing that, you're using at the top a value of the so-called expected economic condition in the future, as the stock market includes the expectations into the future on the US economy, and divided like a reality check by the real current condition or performance of the economy, as the GDP is the current power of the economy. And then you get a measure, so you get a ratio dividing the expected economy by using the stock market valuation divided by the current or realistic today's expectation. And this ratio, which is then the Buffett indicator, is the ratio of those two, should more or less be stable or have just a slight increase, while technology or efficiency allows us even to increase the expected outcome in the future as a basic trend line. So the basic trend line has an upsloping a scope, but at least it then should be a constant upsloping a slight standard value. And then we can see and we can measure then what the situation is. And then we might have extremes. So when the expected valuation, using the stock market valuation or the market capitalization used on the traded companies, in comparison to the real GDP, might reach extremes. So then, and that's kind of reversing to the mean. So you would expect that this expectation is kind of has a cyclic rhythm. So it will reach extremes, and when it reaches extremes, it needs to come back, as with all expectations or feelings or temperatures or emotions. So the measurement of the expectation divided by the real economy is a measurement which needs to float around a certain mean or an upsloping trend line. And then when we think this should fluctuate around a static or an upsloping line, then we are in cycles. So, or at least maybe there's a cyclic behavior of this flow between the expectation and the real one. So that's the calculation, just to start with that, and the expectation. So you can just simply calculate it, you can chart it. The value used is public available data. So you use, in most cases, the Wilshire 5000, which is the broadest US market. And then the GDP is published by the Federal Reserve Bank. So these are public known figures, which you then can calculate on your own. And each charting application allows you to build that information. Yeah, so what then Buffett proposed, and this is, let's look now how this looks like if you put this on a chart. This is how it looks like. So here we see now the calculated Buffett indicator, which is the blue line here. So this is the divided Wilshire 5000 divided by the GDP. And you see it's a percentage measure, which if you take the mean or the historical trend line, and that's what I said, it's by design slightly upsloping, due to technology efficiency, which comes into the economy here. So this gray line is this upsloping trend or mean. And then as every of those measures, we should have now a floating blue line around this mean, which you can see we have. So, and when we reach extremes, and that's what is meant here. So when we reach extremes in terms of standard deviation, so these two lines just indicate the standard deviations to the upside and to the downside. And when we reach these extremes, like touching two standard deviations, so the expectations is 2 times higher than the past normal ratio in terms of US stock market valuation compared to the GDP. That's this extreme here. So the stock markets in comparison to the GDP and the historical mean has reached now or has touched 2 standard deviations of upside deviation to that measurement, which in Buffett terms, then we have reached a point of a kind of bubble, which he thinks then, so the economy is quite overvalued in terms to realistic output of the current economy. And then even the expectation, which is always a little bit higher than the current output, has reached an extreme when we touch the 1 or 2 standard deviations to the upside, and same to the downside. So when you reach the extremes that the US stock prices are at least 1 or 2 standard deviations below the average mean or the historic trend lines, then this is a kind of underrating of the US economy. And you can then check these points in time for sure on the stock or price chart itself. So what we see here is this is the internet bubble, 2000. We all are aware of that. So 2000, this ratio indicated the internet bubble. And the reason I'm pulling that up today is now you see where we are of the ratio today. We are currently these days touching again the second standard deviation to the upside. Yeah, which means in terms using the Buffett indicator, we are from the absolute values. So it's just the current value. We are exactly at those points based on that indicator indicating an overvalued US economy based on the market value. We judge this market, and in terms of reading that indicator, this should conclude that the stock markets needs to come down. The expectations in future returns need to be revised, brought more back to the realistic GDP calculation. At least that's what history told us using that indicator. So you could expect this from the absolute reading. With every indicator, what is not in here is a kind of timing. Yeah, so we reach that point in time in regards to absolute reading today. And that's why I put this session out here today. But this situation could last for weeks, for months. So just reaching that absolute overvaluation based on the Buffett indicator does not tell us anything. Will this be resolved today, tomorrow? Will this continue for the next 2 months, 3 months, half a year? So this is nothing what the Buffett indicator can answer. And that's where cycles come in. So by just the basic explanation on the Buffett indicator, I will now load this data set into our cycle scanner. That's now the next step, which I want to conclude with you. So here we have, and this is, if you're new to cycle analysis, this is what every user of the cycle tools can do. I have now just uploaded that data set. So I've created that data set on my own. As said, the calculation is straightforward, simple. I have uploaded that as a manual data set into the cycle scanner. As we are not interested here in intraday changes or that, so it's more longer term analysis which we're doing here. So this can then be analyzed. So let's start with all data. So let's just reach out to all possible data we have. So this goes back into 1970 something. This is at least when the Wilshire 5000 index data is available. Let's put all data into the cycle analyzer. So let's analyze the past 50 years. This is now using the past 50 years of the Buffett indicator using for cycle analysis. And I'm doing this first to get a clue on what could be, or is there a dominant cycle available? That's the first question. I'm not interested in this first run. I'm not interested into getting a projection into the future. This is what I will do next. But first, and this is why I use all available data, is I want to check if there is a dominant cycle, because sometimes you will not find a dominant cycle in a data set. It does not mean that there must always be 1 or 2 dominant cycles. So therefore, throwing in all data gives you at least the first idea of is there a key cycle in, because not everything needs to be cyclic. And we can answer that question by looking at the cycle spectrum, which we see here at the bottom of the chart I'm highlighting. And what we are looking for, if you're new to cycle analysis, the spectrum shows us on the x-axis every possible cycle length. And in that case, we're talking about weeks. The chart or the indicator is here measured as a weekly data series. So these are 100 weeks, 200 weeks, 300 weeks, and all possible other cycle lengths in between. And what we are measuring here by applying digital signal processing is you see these so-called, or what we call, peaks in this spectrum plot. And if you spot a peak in that spectrum, that means there is a valid cycle in the underlying data set, at least using digital signal processing. So, and as you see, there are lots of little peaks, and that's quite normal. So you cannot really differentiate if one or the other one might be more important. And dominant cycles, and this is what I'm showing here, is when you get a prominent peak in that spectrum, which really stands out, yeah, beside the other peaks in that spectrum. And this is what I'm highlighting here. So sometimes you just see a pure amount of peaks, but there's no single peak coming out of that spectrum as a single peak, which really is a dominant peak also. But in that case, I think just from visually looking at that spectrum, you would all agree that this is a peak which just stands above all the other peaks in terms of amplitude, in terms of the shape. I will not go into all measures. We use different measures now to decide if a cycle is dominant. You see this based on the colors of the triangles, the size of the triangle. So we have a big triangle, it's green, so there's statistical significance. There's a impact on the underlying price movements and the sharpness of the left and right shoulder. So it's a very sharp peak pointing up, so it will hurt you if you try to sit on that. So that are all conditions which qualify for a dominant cycle. Yeah, I will stop here, but that's how we use cycle analysis and basics. So that's why we use the spectrum and need to do different judgments on that spectrum to check that. So we have first, that's trying now to the first answer. It looks like there is one, maybe a second key dominant cycle in the Buffett Indicator series with a length of 180 weeks. Yeah, you see it also here in the table shown as first or dominant ranked cycle. So, and that's not always the case. And this is already an important finding, that also using the Buffett Indicator or the flow of the over expectation, under expectation compared to the GDP of the economy has a rhythmic nature, or at least some dominant rhythmic natures embedded. And the 180, if you're following this channel, you know that even 180 weeks is a special rhythm. I will not use this session to dive into that even more, but even if you check previous videos, 180 week cycle is important, not just using that indicator series. So it's showing again a very important cycle in the economic and financial landscape anyhow, that series. If we look at the second most dominant peak here, that's also interesting. It has 360 weeks. And the point I want to make here is, if you have close attention to that length, it is an harmonic relation to the 180 cycle. So multiply 180 by 2 and you arrive at 360. So I would not conclude these are two cycles. This is anyhow just one cycle with his harmonic relation. So parent or child, or call it however, there's one key cycle with another harmonic cycle now also showing up into the spectrum. This relates, these two cycles relate very closely. If you just think there might be two cycles, yes, from a data simplistic view there are two, but they are in so close harmonic relation by the factor of 2 that there's one key cycle with the harmonic child cycle 180, 360. So that's why I don't pay too attention to two cycles. Let's use these two, but let's see this as one dominant rhythm with the parent and the child. So that's just the overall analysis. Yes, it will hurt you if you try to sit on it. Maybe I need to remember that slogan. What is a good cycle peak in the spectrum? Correct. Okay, so that's the long-term perspective. What we're doing now, we can activate that kind of cycle or overlay that cyclic period and plot that on the chart. So this is what I'm doing now. So what we see on top is the 180 week cycle. Yeah, so the duration from top to top is 180 weeks. Just over this Buffett indicator, going back into 1970. And you just see from scrolling over the main topics here. So here we have the year of 1983. And you know that we use cycle analysis for timing, not for doing predictions in regards where will this indicator value be at the top or at the bottom, just at which point in time do we expect that indicator or that asset to change its direction. So you see here is the key top. So here we have the low. So here we have a low, here another top. So you can just scroll over it. Here the internet bubble, the bottom of the internet bubble. Here the 2007 top here. So the banking crisis, even timing of the low. Then the next interim top here. Even this interim low here, I mean, that was not a big topic, but here from here to here. Then we have the next top in 2021, the bottom in February or somewhere in 2023. And you see where this is approaching now. So, and that's now we come closer to what we are interested here. So first we have the cycle. Now let's see, okay, we have analyzed, or we can even spend more time going over it in the past. Now let's look where we are today and what does this mean looking into the future. Now a second topic comes into play. We need to adjust the way how we did the analysis. And that's also important always when we are applying cycle analysis, because for now I have used almost all data which is available. So throw all data in, just show me, is there a dominant cycle? And this gives me an answer about if there is a dominant cycle and what length that cycle might be. Yeah, for sure. And I can use to plot this into the future. But let's be careful here, because we are kind of averaging the cyclic condition as we deal with the theoretical symmetric cycle. What is plotted here is just the theory of a perfect symmetric cycle which has been static over the past 50 years, which it is just theory. Okay, so it will not really help us to fine-tune our projection into the future, because we have just more or less averaged this set of 50 years of data. And working with static symmetric cycles is a very, very simplistic model. So one way now to overcome that simplistic cycles model is, okay, we want now to have a better view where we are in that cycle. And if I'm talking about how to fine-tune is, from a cyclic analysis point of view, we call this the phase of the cycle. And the phase of the cycle is where are we today, at that point of cycle here. So, and if we use all the data, this is the point where we are today, and then you can extrapolate that cycle into the future. And this point here is the status of the phase of that cycle. But as said, this is the average phase. It would be better if we have a quite better indication. Maybe we are already here, or maybe we have already passed the top, or maybe we are already here. So we are just interested at this cyclic situation of that half of the overall cycle. We are not interested on the past 50 years of the 20 repetitions of that cycle and having the best fit of these 50 repetitions into the full past. We don't care. Now we are interested in where is this cycle in its phase today, now. And in order to do that, we just need 2 or 3 repetitions. We don't need all the 20 repetitions going back 50 years now. We should have 3 repetitions. I mean, we need 3. If we don't have enough data, then it's also garbage. But if, as a rule of thumb, if we can have 3 repetitions of that cycle in the data set, then stop there. Don't add more data to your analysis. Your data analysis will not become better. So that's what I'm doing now. I will shorten the amount of data used for the analysis. So let's clean up. Let's grab a fresh start here. And this is, by the way, anyhow, how the cycle analyzer will start up. We will just use the past 850 data points. Basic setting, you can adjust that however you like, but this is the starting point, which means the largest cycle length would be around 300. Multiply 300 by 3, you arrive at 900 data points, so you would have the need for 900 data points if you want 3 repetitions of a 300 weeks long cycle, which is far enough for our 180 week cycle. Not more. So it's enough to go back into 2009, not into 1970. And now let's look into the spectrum. First, we need to check if even if we use a smaller amount of data set, if the cycle is still there, because it could be the case that in the past 10 or 11 years, which we are analyzing here, maybe the 180 week cycle was not there or was not as dominant as in the overall 50 years period. So that's the first cross check. And what we see here is it shows now at the peak of 178. So which is 180. So that's why we often call it a nominal cycle. The nominal cycle is the 180 weeks, which is the average. And now if we shorten the amount of data and the analysis gets better, not just using not so much data will not hurt it. So we have a more precise data now about that cycle length. It's 178 weeks because cycles vibrate or cycles are not as static. They always slightly shift in their length. So, 178. And by using this amount of data for the phasing, so where are we now, we also get a better information. Where are we? And now let's have a look. If we activate the 178, get back to the chart. Now we have a much better or more exact information. Where are we in that cycle? And this is what is showing up here. So it's quite similar. So not a big change at all. But this is what I always do to get a better feeling of where we are in that information. Yeah, and that's now this is what I promised. We get a timing. I want to see it. Let's jump. Even it's on the top. So, okay. So the top is here. That's what you're seeing here. And if we go down, it is end of October, beginning November this year. So now we have an answer to the question we are trying to answer here. So we expect a top in the Buffett indicator, which means at that point in time, we could expect the Buffett indicator extreme, to come back or to revert to the mean value again. It's just a reversion to the mean. That's what cyclic behavior is around a mean. And this should start or take place, if we project this into the future, end of October, beginning November that year. So here you have it. We have already the absolute maximum reading of that indicator. So we are at an extreme valuation. I mean, that's nothing new. I'm telling you here, this is what the media news report every day. But now we have the additional timing information that we could expect this indicator to revert back to the mean condition starting or reaching extreme end of October. So, and that information is even maybe more worth than the absolute value on its own. And just knowing that these 180 weeks is also in alignment with the key cycle in the broader US markets per se is an additional confirmation. So this timing information now helps us having another closer look onto technical indications, which might show up during the next 2 to 3 months. What do we have now? So July, August, September, October, maybe 3 to 4 months to go. Maybe that strange situation might continue. We might see more divergences out there between different stocks. we might see different money flow values, new highs, new lows, and divergences for that. And that might maybe then, from a timing perspective, lead in October, November to reverse that condition. So I think the consequences then should be clear. Last but not least, just for fun, I have also overlaid that to some stock market data. Let me switch to that here. No, going back. So that's the key message. If we want to stay with me for 5 to 10 minutes, what we could do, and now I'm switching back to all data, just redoing the analysis we had. You see now these two cycles. I just talked about the 180, right? But I said that there is a parent, there is a harmonic relation with the 360-week cycles. And now, if we now extend our analysis, let's also activate this parent cycle, the 360 cycle. You see the wave shape gets a different shape. And if you zoom in, it's so fascinating here. I mean, do you see this drop here? This was the 98, the quick top, and this short crash here exactly into the bottom of that cycle, and then the upswing in where both cycles then peaked. So this peak here, or that top, is the timing information where both cycles topped. And you see, I mean, that's so beautiful, seeing that bottom here at this interim child cycle here. And then if you revise that cyclic even more, you find different of those examples here. Here again, the 83 top here, then the interim low, then another top, and even starting in 1972 with this top here. So it's quite a fascinating. And let me end with the overlay of that cycle just on a price chart here. So this zigzag curve is the composite cycle of the 360 weeks and the 180 weeks, just shown as a zigzag curve here. Just for fun, if you overlay that here on a chart, I mean, and this looks like you are connecting some dots here on the price chart, which we are not doing. This is a pure time cycle, and this is the price chart here. And you see from a timing perspective how overwhelming, interesting these even shorter term peaks and troughs are. But that's more or less for if you're really interested in digging deeper into that cycle analysis. That's it. So I think we have a clue. We have a finding, 180 weeks with a parent of 360, but no different picture in regards to timing. October, I told this already from different other analysis, October is really, really an important cyclic window long-term based on the 180-week cycle, also seen in the Buffett Indicator. So let's check it out. What happens in the next 3 months. Thanks for joining me. That's the analysis for today. The purpose was also to inspire you to look at economic data sets for your cycle analysis. It's not always the raw price of an asset and stock or indice. Look out for these kind of ratios, which give you also a clue on economic conditions, economic ratios, gold to stock market to whatever ratio, and then think about, is there a rhythm in that ratio? And if you find these rhythms in ratios, this gives you an additional clue on timing information for one or the other asset. I mean, you analyze two assets by using a ratio analysis, so both assets could then go in the one or the other direction. That's the purpose of ratios. But it really opens up a perspective or a different perspective than just using raw price cycles. So that's it for today. Everyone can use that kind of analysis by uploading this data set into the Cycle Scanner. It's just a 2-click effort, and then you have the data set up and running. So that's it for today. If you like, we can spend some time on your questions. I will now pay attention to the chat section. Just give me a second to ramp up some questions, and if you have some, just throw them in. I will be here. Okay. Maybe we need to really remember that. Let me bring in that comment. Give me a question. Why? Yeah, I put the wrong one. Maybe we should put that to the cycle analysis documentation. What is a good peak in the spectrum? If you try to sit on it and it will hurt, then it's a good peak. Maybe that's something which I always try. You need simple statements. Get away from this mathematical topic nobody can recommend. Yeah. Thanks for that. Live last. So how can you get clean GDP? Is this gross net inflation smooth? Your question, to be honest, is over my head right now. What I'm using is I'm just using the FRED. FRED is a data source from the Federal Reserve Bank of St. Louis, which provides these GDP measurements just as a data set. I grabbed it from there. I just need to recheck. But it should be easy also to use different GDP measures. So we need to look it up at the FRED source, what exactly their calculation method was. But if you want to get a clue what was used here in that video, it's the basic FRED GDP information, which is available from the service. Does the second standard deviation from mean still apply after the data has been detrended? Yes, I think so. So I mean, otherwise we would have the upsloping or the upsloping standard topic would be the detrended version. So that's then also the two standards from the mean. So yes, we have excluded that by detrending, and the two standard deviation would still conclude. However, from the cyclic behavior, we are not specifically looking at two standard deviations. So that's more what Buffett or the mathematical readings used. So the cycle does not in specific look for these two standard deviations. Okay, so my voice is telling me time out, but let me think about if I can survive some minutes. Yeah, Gulibrex, that's a fair question. How do you count 180 weeks? I mean, from bottom to top or from bottom to bottom? So absolute valid question. So because that's important to understand. And it's measuring from top to top or bottom to bottom. I mean, that's the same, but not bottom to top. That would be half of that. So 90 would be bottom to top. 180 is top to top or bottom to bottom. So it's an absolute valid question. Guil Brex. Yeah, Pov Wells, yeah, your question is absolutely right, and we could fine tune that. I would not expect a different setting. So the standard setting is 850. So 850 divided by 3, what is it exactly? I need to look it up. So this would give us valid cycle length. I just do it in parallel. 850 divided by 3, 280. Yeah, so if we want to have valid 360, we should use a little bit more. Absolutely right. As I was more looking to the 180 week cycle, then 850 is more than enough. So, but you are absolutely right. If you want to have more confirmation on the 360 weeks, you should extend the analysis. And let's do this. Let's do it together. 360 multiplied by 3. So this means you should have at least 1,000 data points in order to get the 360-week cycle better confirmed. So that's absolutely right. And let's just quickly do that here together. So let's clean up, fresh chart. So the standard setting is 850. It's not a calculation, it's just the starting point, which is quite enough for the 180 or 178. But you see here, it's just a small bump here. And here you can sit on that, yeah? It won't hurt you. So it's not a perfect cycle. And to use the calculation, you need to add more data. Let's just do that. And I will now extend the analysis into the past. So let's not exactly 1,000 data points, but let's use this low here in the year of 2002. Let's refresh the data now. And now it's using 1,100 data points. I have aligned it to that low here. So it does not need to be exactly that number. And now let's have a look at the spectrum, and you see the 178 is still there. Yeah, 180 now, but this cycle is still there, even more prominent. Now you see it looks like even the 360 is valid. Now it starts to bump up, and you see the extension of using more data makes it more possible to also detect valid these longer term cycles. It is not 360 in that case, so the longer cycle is more leaning to 370, 380 in that case, but we can also pick those two. So I agree with you on that analysis. And just doing it very quickly, if you use both cycles in that composite model, you will arrive at December this year. So October, November, December, in 360 weeks. I think we're talking about 80 years. It's a very long cycle, but it's still the same. Or from a timing perspective, we arrive at the same measurements. But Bothwell's a valid point. I hope this helps a little bit. Doing this live here to show you how to work with that. Yeah, Fritz, also interesting question. There is an option, fill missing days. There are 3 choices and they give different results. When do you choose which option? This is mainly related if we analyze, or if you analyze daily data sets, because using daily data sets, you need to tell the analyzer how to deal with missing days at daily days. And normally it would not do anything to your data set. So it uses the data set as you put it into the computer. Nothing will be done. So you have then 2 choices. You could just fill the set to have a complete calendar days series. So it makes Monday to a Sunday. So the complete week is always complete. So business days will be filled and weekends will be filled to always have a complete calendar days daily series, or just weekdays. If you choose weekdays, the weekends will in most cases be skipped out. So you just have a complete five days week, because due to stock market holidays, you could have missing weekdays, and just to compensate for that, you could click weekdays, and this will then fill in just the weekdays, not the weekends. Said that. So that's the 3 different options. When to use which? Start with none. It will not. I mean, it will show you different cycle length, but the timing often is very similar, because the length is different, because either way you just calculate 5 days a week or 7 days. So the length is for sure different if you have calendar days or just trading days. But often the timing consequences, and that's what we are interested in, you want to read the timing indication into the future, is often similar. So it's more flavor, which depends on if you more consist or want to have consistent calendar weeks series, including the weekend, or if you can skip it and don't take care of these exact or flavor of having completed weeks. In my experience, it does not make a huge difference. You just need to stick to the one or the other. You should not always switch it. Then you get confused. From a timing forecasting perspective, it's not really a big difference. Maybe it depends if the asset is trading on weekends or is not trading on weekends. That could make a difference. So think about if your asset is trading during weekends, then always use calendar days. If not, don't bother with weekends and weekdays. Okay. Cycles in GDP alone, Richard. That's an interesting topic. No, I did not look into this individual series. But it's a good idea to add now to that analysis to also see maybe if the GDP on its own has additional cycles, which then from a timing perspective align or do not align from a cycles within cycles approach. Thanks for mentioning, but no, I've not done this in specific. Yeah, maybe last topic for today, Attila. This is around the time of the US elections. And this is what I often repeated. So the October period is exactly when you had the US elections. So it looks like something will change afterwards from the US stock market economic financial cycles perspective, looking from different measures. Yes, that's also a finding. And yes, we are discussing this in the foundation with our colleagues, which are then more experts on seasonal and, for example, presidential 4 years annual cycles. And that there's no common sense in that interpretation. And I'm not the expert on that, but maybe we should bring in other colleagues here from the foundation to maybe talk on the presidential cycle. So at least you spotted the point in time when this shows up. Okay, really last question for today is, and because two of you asked this now, so Lars, could you please please tell how to upload the data? Now the ideas section. Keith, yes, let's do it. I will do this just after the session. Give you a minute, but it's a good point. And I will put the idea in the video description down below. So Keith, please wait 10, 15 minutes for a short bio break. I will upload it into the ideas section. I will put the link here, and then you find exactly that analysis, and you can follow up on your own. And then thanks for bringing this up. And now, last but not least, it looked like the same, but how to prepare and upload the data. So just simple, how to upload data or how to prepare data. I use a sharding application to prepare my data. You can prepare your data in TradingView. You can export data in TradingView, download as ZSV, comma separated values. The way to upload then is just as simple as that. You head to the dataset section. You have the datasets area, and there's the button Upload New, which brings you to an upload area. And the information how the dataset needs to look like is just if you press the plus button here. So you can more or less upload whatever comma separated values you have. Even Unix timestamps work, ISO dates will be interpreted. So it's not dealing about open, high, low, close. You need to decide which value. So dealing with close data. But if you have this kind of series, just drop the file here from your local computer, and that's mainly it. And then you have it right away and can analyze it. Ashkumor. All right, let's call it a day. I hope you liked the dataset, the consequences, and some follow-ups. So please join Richard tomorrow for some intraday follow-up topics. Don't forget, we have the 24th June Financial Summit showing up. Head over to cycles.org, register for that event. And for sure, I hope to see you there next week, Monday, same time, same place. See you there. Have a safe week. Bye. See you.